Hello, everyone, and welcome to the latest TM Brunston Market Update. I hope that you're all keeping safe and well during these very unsettled times. I'm pleased to have with me once again Mark Shields, Investment Manager from Brooks Macdonald, who will be discussing, as normal, some topical questions. Mark, thanks for joining us again. One of the burning questions, of course, is obviously to do with the Russian and the Ukraine situation at the moment. From your point of view as an investment manager, has the recent geopolitical turmoil created opportunities in the renewable energy space?
Yes, Brian, it definitely has. I think what we've obviously seen is the tensions between Ukraine and Russia have led to lots of question marks regarding the energy dependence of lots of Western countries, especially in Europe, on sources of energy that they get from Russia itself. Very, very well well highlighted in the press and other media sources. So what we expect to happen, and what I think the market is beginning to look at more and more, is the likelihood that those Western energy consumers, so places such as Germany is the classic example, but lots of other Western European countries as well, are likely to accelerate their programs for energy independence. And the best way that most of these countries can do that is via renewable energy sectors such as wind, solar, hydro, and indeed maybe more controversial areas such as nuclear should possibly be thrown into the mix as well. So whilst in the near term we expect a lot of these countries to be trying to source energy from wherever they can, as cheaply as they can, as quickly as they can, which probably will translate through to more higher use of dirty fuels such as oil or oil derivatives, gas, etc. We think in the medium to longer term, the plans for renewable energy rollout are going to be accelerated, and that provides a really good opportunity for funds such as the 91 Global Environment that we hold in the portfolios, that has roughly a third of its exposure to renewable energy generating companies, alongside some of the other companies we have in less dedicated funds in the portfolio. So we are seeing a bit of an opportunity there over the medium to longer term, once I think we've got past this kind of possible very short term focus on getting energy from wherever they can as cheaply as they can.
So a general move, as one would start to expect now, more towards countries being more self-sufficient, Mark?
Yeah, absolutely. And I think the difference really is yes, a lot of these programs were in place to wean these countries off of their dependence on oil. I think this is probably just going to accelerate the program much more rapidly than we were seeing prior to this event. I do think in the short term there will be some question marks over this, but over the medium to longer term, I think the direction of travel is fairly clear, and I think the speed at which we get there, I would hope, will probably be quicker than maybe it was at the beginning of the year.
Okay. Every cloud, as they say, has its silver lining. Which areas of the market exposure to technology are looking interesting at the moment?
Yeah, again, this is quite linked to what we're seeing in geopolitics as well. Technology has really come under pressure year to date because it's classed as a growth sector, and we've seen inflation and interest rate expectations change quite dramatically over the past few months. And as interest rates go up, that tends to mean that highly valued growth stocks become less compelling. We've seen a bit of a baby out with the bathwater type situation here, where a lot of a lot of companies that are deemed to be growth, even though they're continuing to perform exceptionally well, have had their share prices knocked quite heavily. And these are the parts of the tech space that I think are looking quite compelling at the moment. So the sort of companies within the tech space are not the highly speculative companies, not the companies that are maybe running on stressed balance sheets or indeed not making any money at all. Those are the sort of companies I think should probably continue to be avoided for the near term at least. But actually, the sort of core tech companies that are out there, companies such as Microsoft, which generates a lot of its revenues from cloud computing services, which companies just cannot dissociate from very easily. And areas such as cybersecurity. Again, this is an absolutely fundamental part of the technology space that companies and countries are going to increasingly need to spend money on, especially in light of what's happening at the moment between Russia and Ukraine. So I think those core cash generative, very strong balance sheet companies within the tech space are still looking very compelling. And if you run valuation data, you can see that actually a lot of these companies are not looking stressed. They're not looking overly priced compared to long run historical averages. So, we think there are some opportunities within that space for companies that have come under some pressure. And within subsets of those companies, such as cybersecurity, we think there is a particularly interesting opportunity. And again, the fund that we have, the main fund that we have within the Brunsden funds with exposure to technology, has roughly 12% exposure to cybersecurity or cybersecurity derivative companies. So there's a good exposure there, and we think there are some decent opportunities within a sector that has frankly been quite unloved year to date.
Okay, and that overlaps onto my third and final question, which is really expectations for 22 and the years ahead. Opportunities, Mark. What opportunities do you see for investment purposes up ahead?
Yeah, I think again there's some interesting areas that we're looking at the moment. I think an awful lot is going to depend on what happens between Russia and Ukraine, what happens with central banks, specifically the Fed, whether they do dial back their or possibly even sort of accelerate their interest rate rising program. There's a very strong argument emerging at the moment that the higher energy prices may well be sufficient to curtail the Fed's plan to raise rates quite as quickly as they are forecasting at the moment, and that would probably be quite beneficial for risk assets such as technology, as I've just mentioned. So I think there's a lot of moving parts at the moment that we would like to get some clarity on before making any big changes to the portfolios. However, we do think that there are some opportunities, as I've already highlighted, within the renewable energy space, within parts of the technology space, within cybersecurity, also within agriculture. We're seeing wheat prices increase dramatically. Wheat and soy and corn are some of the biggest foodstuffs for animal feeds. So again, our environmental fund has exposure to meat alternative products, which again is an interesting area if we're sort of seeing meat itself become more expensive. Fertilizer prices have gone up dramatically. Russia's a major exporter of phosphates. So, there's opportunities within some of these parts of the market that we already have exposure to. I think in the near term, we're probably playing a bit of a watch and wait game to see what happens with regards to Ukraine and Russia and the Fed. But I think if we see a possible resolution there over the next few months, combined with a possible less hawkish tone from key central banks, I think that could be a very interesting opportunity to increase exposure to risk assets in the portfolio and make sure that we ride any resurgence in those assets off the back of that, with a view to ultimately potentially then sort of restarting that program that we had at the end of last year of producing portfolios that are more balanced between growth stocks and cyclical stocks for 2023. Obviously, that's a little bit of crystal ball stuff, and a lot of moving parts going on there. But that is a scenario that we feel is reasonably likely at this point in time. But need to caveat a lot of that with the fact that some of that might well change, especially when we're looking at central banks.
Okay, that's great, Mark. As they say, every cloud has a silver lining, and that's what we like you doing, looking for opportunities up ahead that benefit our clients. So, Mark, thank you very much, and thank you for watching. And as always, if you have any questions or queries, please be in touch with us. Thank you.